Hey there, and welcome back to the Young Investor Podcast. I'm Ollie, and today we're diving into a topic that might sound a bit academic at first glance. But trust me, it's shaping your investing future in ways you might not even realize. We're talking about the rise of economic statecraft. Think of it this way. Nations are no longer just using armies and diplomats to get what they want. They're increasingly using money, trade, and investments as their most powerful tools and weapons. And understanding this shift is crucial for you, the young investor, navigating today's global markets. Economic statecraft describes how countries use economic tools to achieve their foreign policy goals. It's about influencing the behavior of other nations through financial and commercial levers. For example, if one country wants another to stop a certain action, instead of sending troops, they might threaten to stop buying their products or lending them money. It's an approach that aims to shape the international landscape without necessarily resorting to direct military means. There are two main ways countries apply economic statecraft. The carrots or incentives are the rewards offered to encourage cooperation. Examples include foreign aid, favorable trade agreements, investment opportunities, or even work visas. The goal is to create or expand the flow of resources between countries, whether it's goods, services, people, money, information, or ideas. The sticks or punishments are the penalties imposed to coerce or punish. They include sanctions, tariffs, or restrictions on financial transactions. Sanctions can be broad, targeting an entire country, or smart, aimed at specific individuals or groups to avoid widespread collateral damage to innocent civilians. The goal is to deter or compel a change in behavior by disrupting economic exchange. It's helpful to think of it like parents using rewards or grounding to influence their children. Countries use economic carrots and sticks on the global stage. A term often used interchangeably with economic statecraft is geoeconomics. Geoeconomics is a broader concept that focuses on the strategic interplay between economics and geopolitics, which is the study of geography's effects on politics and international relations. Essentially, geoeconomics encompasses a wide range of economic policies and global power dynamics, examining how economic power shapes global relations. This increasing interconnectedness and the frequent use of the terms economic statecraft and geoeconomics indicate a fundamental shift. Economic power is no longer just a supporting tool for foreign policy, but has become a primary and integral means to achieve national objectives. This suggests that national security is increasingly defined by economic strength and leverage, rather than solely relying on military might. For investors, this means that understanding global economic trends requires a simultaneous grasp of geopolitical intentions, and vice versa. Economic news is, in many ways, geopolitical news. So why are we seeing more of this now? While economic statecraft is not a new phenomenon, its prominence has grown significantly in recent decades. History shows ancient examples, such as the Roman Empire banning silk imports in the 1st century to prevent gold outflow. Even during the Cold War, the United States and the Soviet Union employed sanctions, trade embargoes, and foreign aid as foreign policy instruments. However, its scope and importance have dramatically increased. The world is more interconnected than ever through trade, finance, and technology. This global interdependence makes economic tools far more potent. If countries rely on each other for goods, services, or capital, disrupting those flows can have a huge impact. Nations' increasing reliance on global trade and investment has made economic coercion a powerful tool for influencing other states' behavior and achieving a wide range of foreign policy objectives. Following the 9/11 attacks, the United States dramatically expanded its use of economic tools, especially sanctions and anti-money laundering measures, as a core part of its national security strategy. Between 2000 and 2021, U.S. sanctions usage increased by over 933%, making them a tool of first resort. The importance of this economic dimension to national security is underscored by the fact that, in 2017, the U.S. Treasury Secretary became a statutory member of the National Security Council. The United States' centrality in international economics and finance, with the U.S. dollar serving as the world's reserve currency and unit of account for much cross-border trade, gives the U.S. unparalleled power in applying economic statecraft. This prominence of economic tools in U.S. foreign policy execution is an enduring legacy of the post-9/11 national security reforms. The dramatic increase in the use of economic statecraft, particularly by the U.S. after September 11th, signals a strategic shift where economic measures have become the preferred tool of first resort instead of traditional military interventions. This implies a perceived lower escalation risk for policymakers, but a higher certainty of economic disruption for global markets and businesses. International conflicts and security concerns are increasingly likely to manifest as economic pressures, tariffs, sanctions, investment restrictions, rather than direct military conflict. For young investors, this translates to a world where geopolitical risk is more likely to affect your portfolios through inflation, supply chain disruptions, and market volatility stemming from economic measures, rather than just traditional warfare. This demands a new lens for viewing global stability, one that prioritizes economic resilience. Economic statecraft manifests in various forms, with direct impacts on the global economy and financial markets. Sanctions are measures aimed at restricting trade and financial transactions, with the goal of coercing, weakening, or signaling disapproval. They can be comprehensive, targeting an entire country, or smart, aimed at specific individuals or groups. A prominent example is the Russia-Ukraine war and associated sanctions. Following Russia's invasion of Ukraine in February 2022, a wide range of sanctions were imposed on the Russian economy, oligarchs, and government. While these sanctions did not directly target the agricultural sector, they contributed to spikes in global food and energy prices due to disruptions in raw material exports like oil, gas, wheat, and fertilizers from Russia and Ukraine. Furthermore, the concept of secondary tariffs has emerged, referring to punitive measures not directly imposed on Russia, but on third parties like India and China that continue to trade with the sanctioned country. These measures risk widespread collateral damage and global inflation, as they aim to economically isolate the target country by deterring its trading partners. Sanctions, while powerful, often carry significant unintended consequences, harming non-targeted entities or civilian populations. Their overuse can lead to diminishing returns, as target countries develop an immunity by seeking alternatives to the sanctioning country's markets or financial systems. For instance, China and India might accelerate deals with Middle Eastern suppliers or boost yuan-based trade to bypass dollar-based sanctions. This approach can also strain diplomatic relations with allies, as demonstrated by the U.S. threat of secondary tariffs on countries buying Russian oil, which could harm ties with China and India. This implies a complex and often unpredictable impact on global markets and supply chains, requiring investors to consider the broader ripple effects. Trade agreements can offer preferential market access and strengthen diplomatic ties, while tariffs are taxes on imports/exports, often used to protect domestic industries or pressure other nations. The U.S.-China trade war is a clear example. Initiated in 2018, the U.S. imposed tariffs on Chinese goods, aiming to force changes in alleged unfair trade practices and intellectual property theft. This led to retaliatory tariffs from China and had significant consequences. Higher costs for consumers and manufacturers, increased consumer prices, manufacturing contraction, and job losses in the U.S., especially for farmers. The trade war also slowed global economic growth and led to shifts in supply chains, with some trade being rerouted through other countries. Trade policies, traditionally viewed through a lens of economic efficiency, are now explicitly weapons for national security and geopolitical advantage. This leads to increased protectionism, forced technology transfers, and a significant rerouting of global supply chains, fundamentally altering the international trade landscape. The pursuit of national security objectives, such as protecting critical technology or reducing reliance on adversaries, directly leads to trade restrictions and tariffs. For investors, this means that company profitability and growth are no longer solely dependent on market forces or efficiency, but are heavily influenced by geopolitical alignment and national strategic priorities. Supply chain resilience, such as reshoring or friendshoring, becomes a key investment consideration, potentially leading to higher costs but greater stability in certain sectors. Countries use foreign aid, loans, and investment policies to promote their foreign policy objectives, build alliances, and influence other nations. China's Belt and Road Initiative, BRI, is a notable case. Launched in 2013, BRI involves China lending billions for infrastructure projects, power plants, roads, railways, digital networks, in developing nations worldwide. While presented as a path to mutual growth, it serves China's economic goals, slowing growth, excess capacity, securing raw materials, reorienting global commerce, and political objectives, increasing political influence, influencing territorial disputes, control over infrastructure, and projecting global leadership. Concerns exist about debt traps, where countries struggle to repay loans, giving China leverage, such as Laos losing control of its power grid. Large infrastructure loans, exemplified by China's BRI, can create debt traps for recipient countries, granting the lending nation significant political leverage and even control over critical national assets. Recipient countries' inability to repay large and often opaque BRI loans provides China with leverage to demand concessions, including control over strategic infrastructure. This transforms economic dependence into political and strategic influence. This situation creates a new form of geopolitical competition where economic dependence becomes a tool for projecting power. For young investors, this means that investments in countries heavily involved in such initiatives carry a unique geopolitical risk. The long-term stability and economic sovereignty of these nations can be compromised, affecting the viability of local businesses and the security of foreign investments. Countries are increasingly scrutinizing foreign investments, especially in sensitive sectors like semiconductors, artificial intelligence, quantum technologies, and critical infrastructure, due to national security risks. The U.S. Committee on Foreign Investment in the United States, CFI-US, reviews inbound investments, and there's a push to expand its scope and potentially screen outbound investments. The European Union is also tightening its foreign direct investment, FDI screening. Foreign direct investment, both inbound and, increasingly, outbound, is no longer just an economic transaction but a critical national security concern. This leads to stricter screening regimes, particularly in sensitive technology sectors, fundamentally reshaping global capital flows and the landscape for mergers and acquisitions. The perception of threats from foreign adversaries, especially China, acquiring critical technology or intellectual property through investment, or strengthening their military capabilities through domestic companies receiving foreign capital, directly leads to government intervention and screening mechanisms. For young investors, this implies that investment decisions are increasingly subject to geopolitical approval, not just market viability. This also suggests that capital flows may be redirected towards friendly nations or domestic industries deemed strategically important, creating new opportunities in some areas and closing off others. Economic statecraft isn't a distant concept. It has a direct and tangible impact on your personal finances and your investment decisions. Economic statecraft, particularly through sanctions and trade restrictions, is a significant and direct contributor to global inflation and exposes critical vulnerabilities in supply chains. This directly affects your purchasing power. For example, the U.S.-China trade war led to higher costs for consumers on everything from electronics to home appliances. Sanctions related to the Russia-Ukraine war caused spikes in global energy, oil, gas, and food, wheat, fertilizers, prices, impacting your grocery bill and your gas tank. Government policies like tariffs and sanctions directly interfere with the free flow of goods and capital, increasing costs for businesses, which are then passed on to consumers. Disruptions to key raw material producers, such as Russia and Ukraine for energy and food, create shortages, driving up prices globally. For young investors, this means inflation is not just a monetary phenomenon but increasingly a geopolitical one. Your investment strategies must account for persistent inflationary pressures and the potential for supply chain shocks. Geopolitical events create uncertainty, causing financial markets to swing dramatically. This can affect stock prices, bond yields, and currency values. Investors often seek safe haven assets like gold, the US dollar, or the Japanese yen during these periods, while riskier assets may experience sell-offs. Geopolitical tensions, while not always causing immediate market crashes, are a significant driver of market volatility and capital reallocation. Uncertainty stemming from geopolitical events, conflicts, sanctions, policy shifts, causes investors to reevaluate risk, leading to rapid shifts of capital from assets perceived as risky to safe havens. This reallocation, driven by fear and speculation, directly impacts asset prices and market indices, even if the long-term economic impact is unclear. For young investors, this means staying informed about global political developments is no longer optional. It's a necessity for understanding market movements. Investment strategies need to incorporate resilience against sudden shocks, and a cool-headed analysis of geopolitical risk is as important as financial statement analysis. Economic statecraft directly shapes the flow of capital. Governments are increasingly restricting foreign investment in sensitive sectors like advanced technology, semiconductors, AI, quantum computing, critical infrastructure, healthcare, and even farmland. This means some traditional investment opportunities may become riskier or even inaccessible, especially if they involve countries deemed foreign adversaries. On the flip side, it can create new opportunities in domestic industries or allied countries that are strategically important. Economic statecraft increasingly targets specific strategic sectors, e.g., advanced technology, critical minerals, energy, agriculture, and geographies. This creates a bifurcated investment landscape where certain areas face increased restrictions and risks, while others, often aligned with national strategic interests or allied nations, may see an increase in domestic or friendshoring investment opportunities. Governments are actively using investment screening and other policies to protect perceived national security interests, prevent technology leakage, and ensure supply chain resilience in critical areas. This direct intervention shapes capital flow, directing it away from investments linked to adversaries and towards strategically important domestic or allied sectors. For young investors, this means a purely profit-driven investment approach may be insufficient. Understanding which sectors and geographies are deemed strategically important by major powers and which are not becomes crucial. This can lead to a premium on safe or aligned investments and increased risk for those in contested or restricted areas, impacting diversification strategies and long-term portfolio growth. Navigating the current investment landscape, influenced by economic statecraft, requires a strategic and informed approach. In a world of economic statecraft, diversification isn't just a good idea, it's essential. Spread your investments across. Beyond stocks, consider bonds, which can protect against growth shocks, real assets like real estate or commodities, which can hedge against inflation, and even precious metals. Don't put all your eggs in one basket. If you're heavily invested in tech, consider adding exposure to sectors like healthcare, utilities, or consumer staples. While U.S. markets are strong, having international exposure can reduce country-specific risks and offer opportunities when one region faces headwinds. Index funds can be a simple way to achieve broad diversification. In an era where economic statecraft creates systemic risks, inflation, supply chain shocks, targeted investment restrictions, traditional diversification strategies across asset classes, industries, and geographies become an even more critical proactive measure for young investors to build portfolio resilience, rather than just optimizing returns. Geopolitical events introduce non-market-based risks that can affect entire sectors or regions, regardless of their underlying economic health. Diversification mitigates this by ensuring that a shock in one part of the portfolio is offset by stability or growth in another, less correlated part. For young investors, diversification shifts from a nice-to-have for optimizing risk-adjusted returns to a must-have for protecting capital against unpredictable geopolitical shocks. Before investing, truly understand the level of risk you're comfortable with and how long you plan to invest. For young investors with a long time horizon, like saving for retirement, you can generally afford to be more aggressive, as you have time to recover from market downturns. This long-term view helps ride out short-term volatility caused by geopolitical events. It's important to stay updated with global news and understand major geopolitical trends, but avoid getting caught up in the short-term panic of every headline. Focus on reputable news sources and financial analysts who specialize in geopolitics. Learn to differentiate between media hype and actual market impact. The complexity introduced by the rise of economic statecraft demands a higher degree of financial literacy and adaptability from young investors. This can be effectively fostered by leveraging the technology platforms and learning by doing approaches that this generation prefers. The increasing influence of economic statecraft makes traditional investment analysis more complex, as political decisions now directly impact market fundamentals. This creates a greater need for continuous learning and adaptation in investment strategies. Digital platforms and experiential learning are highly effective in delivering this complex education to a generation that prefers technology-driven solutions. This suggests that financial education providers and platforms have a crucial role in empowering young investors to navigate this new landscape. Despite increased volatility, historical data shows that diversified portfolios generally outperform simply holding cash during periods of heightened tension. Focus on your long-term financial goals and stick to your investment plan. Don't let short-term geopolitical shocks derail your strategy. So, what's the big takeaway for you, the young investor? Economic statecraft is the new frontier of global power. It means what happens in geopolitics directly impacts your personal finances, from the price of your groceries to the performance of your investments. But here's the good news. By understanding these dynamics, staying diversified, knowing your risk, and maintaining a long-term perspective, you can navigate this complex world with confidence. If you found this episode helpful, please hit that like button, subscribe to the Young Investor Podcast wherever you listen, and share it with a friend who needs to hear this. And for even more insights and exclusive content, be sure to subscribe to the Young Investor newsletter on Substack. The link is in the description. Until next time, keep investing smart and stay curious about the world around you. I'm Ali, and this has been the Young Investor Podcast.